Julia Lee is joining us from Bell Direct. She is in our Sydney CBD studio. Julia, talk to us about the market action here in Australia today.
It's pretty quiet on the market, but it was all about the trade tariffs. And look, the material sector was the area which saw the brightest green, the most amount of green, and was most impressive on the market. And it all has to do with expectations versus what was delivered. And remember, the market was expecting to see tariffs up to 25%. The initial tariff will be at 10% on $200 billion worth of goods, and then the possibility that they will go up to 25% at the end of the year. But also China's reaction to those tariffs as well. It's only on $60 billion worth of US goods. So instead of being a big punch back, it was more of a whimper or a bit of a pinch back to the US. And then on top of that, you've got the stimulatory infrastructure spend that was announced as well. So look, copper in Shanghai jumped to a 1-month high. That was good. And zinc also having a good performance. And those copper plays on the market were outstanding. We saw Sandfire as well as Oz Minerals up around about 5%.
Yeah. What other sectors do we look to in this market? Because we have had the flip side of the coin being talked about a lot today, that tariffs won't necessarily all be bad for Australian companies. LNG exports from China from the US to China have been slapped with a tariff, so that might benefit Australian LNG producers. Where else can we look in this market for any potential beneficiaries?
Well, I think if we have a look at the main areas, there were areas like chemicals. We also saw, as you mentioned, LNG being one of the areas hit, as well as things like wheat and wine. So across the market, we saw Treasury Wine Estates having a relatively good day. Remember, some of these sectors, we have other things going into play as well. For example, in terms of food production, we have things like the drought, which is impacting on volumes as well as prices of production. So there are other things in the background, but generally, given our proximity to China, the tariffs might be good short to medium term. However, a longer term, it's going to be that global growth story, which is the key driver of our main export, which is commodities, and that's the area that we'll be watching very closely. So a short-term lift, but just watching to see whether we see an inflection point in terms of global growth expectations, which would be a key driver of the Aussie share market, given the size of the materials and the energy sector.
Julia, Austal has won another contract. Austal's doing quite well when it comes to winning these contracts. I had the pleasure of speaking with the CEO in reporting season, David Singleton, and it's an interesting one, Austal, because it doesn't make huge margins on those ship builds, although they are increasing. It's also the aftercare, so the systems that they put in place that they have to continue to revisit and rebuild and refresh those Navy ships that are really helping to drive earnings in the outlook.
I find this such a fascinating company, Nadine. It wasn't too long ago, it was a few years ago, where we were talking about losses on some of these ships that they were building for the US Navy. But the idea is to implement from experience and to incrementally grow margins. So the margin improvement happens early on, and as you deliver more and more ships, it becomes more profitable, as well as seeing a greater margin increase. And certainly we've been seeing that from Austal over the last few years. In fact, if you have a look at the US ship building margin, that's increased from 6.8% to 8.6%, as you would expect as they build more ships out. So the order's worth today, they've won a new contract for 2 more ships. It's worth about 1.6 billion Australian dollars. And given their order book's worth around about $3 billion, it's not insignificant. But really underpinning this growth story in Austal is the US Navy's plans to see a fleet expansion up to 255 ships. So I think at this point in the game, Austal's looking pretty good. A couple of years back, it wasn't looking so rosy, as it was trying to nut out some of those problems from the first ships that were delivered to the US Navy. But I think it's up to something like ship 16 now. So as it gets more experience, it gets more profitable, and you see that margin increase coming through as well.
Okay, and quickly, TPG. I mean, it was a tough day for TPG yesterday after it posted that drop in full year profit and sort of was a little bit cautious on the outlook going forward. Today, we're watching the share price again come in a little bit weak. Just let me check the latest figures. Anyhow, the point being, how do you weigh up what the analysts are saying today? Because a lot are saying, it's still all about the outlook, or I should say the merger, when it comes to TPG.
I think they talk about the merger and the synergies involved because the growth, I think, will take a while to come through. So growth will be faster than TPG building its own mobile network because of this merger with Vodafone. But we've seen the shares coming under pressure as brokers shift their recommendations. And in fact, we've seen a couple of sales come through for the stock as well. Part of that is valuation. You're paying upfront for that future growth. So if we have a look at TPG, it trades on a pro forma EBITDA multiple of 10.5 times. And that's compared to competitors, which are on 6 to 8 times. So that means you're paying for that growth up front and it's already priced into the stock, and now that they have to deliver. But also, if you have a look at the mobile market, it's such a difficult market to make money from. I've been sifting through some of those global telecom companies as well as their strategies, and most of them are down year to date. And I guess if we have a look here in Australia, mobile penetration is quite high at around about 90%. So the new growth's coming from what we call the silver surfers, or the older generation who are, I guess, still adopting technology. But it's data that's growing, and it's being increasingly around content that we're seeing deals happening because phones are becoming more of an entertainment device. So globally, if you have a look at some of the deals, they are based a lot around content. So we've seen AT&T as well as Warner, and of course we're watching the Internet of Things as well. So look, mobile itself has been a difficult area to get growth from, but I think the growth may come from the data and the content side as well as the Internet of Things. But look, year to date, it's been difficult, not only for telecom companies in Australia, but across the globe. But of course, TPG has bucked the trend given its merger with Vodafone and the massive surge we've seen in the share price there.